Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on January 16th, 2023. There's no trading today. It's Dr. King's birthday. A reminder, tomorrow, January 17th at 11 o'clock Eastern, I'm going to be broadcasting, if you want to call it that. And I'll be from Rome. I'm scouting around, chatting with people, finding out what's going on in Europe. It's a pretty good place to do so. We had a busy week last week. We opened and closed a series of trades. It's following the pattern, for those of you who are new, of getting out of the way of the market. And we get out of the way of the market when we hit our goals. And those goals are based on the annualized rates of return. And as you can see, the absolute returns was 0.5, 0.5, 0.4, but lots of cash. And the annualized rates of return were very, very, very high. So you can see it was a busy week. We rolled positions in some of our core positions. We sold, and you saw for the previous chart, we sold and then closed a bunch of positions. And I want to talk about this number. This is the number. Our goal is a 26% annualized cash return based on a mythical $50,000 in capital allocated to the trades in this service. But then we go and we do some math and we say, well, we actually committed, if you sold one contract, $32,717 in capital, one contract. This is what the rate of return looks like. And man, it's pretty good. So you can see there's a mix. The overall performance of our new trades, our roll trades, our calls on shares, that's quite a mix. It was a coincidence, I think, that it's 0.8, but given volatility in the market, given the way we've been moving in and out, given the way we focus on cash, I think the consistency of those returns is extremely important. Now, last week, we had encouraging inflation data. Market goes up. We had earnings data that was strong. Earnings forecasts were meh. Market didn't like that because they're concerned. Some traders are concerned more about inflation and interest rates. Other traders and most investors, which are different than traders, are concerned about the economy. This kind of tension, and I've been loath to say this out loud because so much has followed. If the market goes down, 85 out of 100 stocks go down, or vice versa. We're close to, or we are at inflection point in the market, inflation concerns versus recessionary concerns, and that means stock picking. Because after we get through earnings seasons and CEOs have spoken and fourth quarter earnings are, especially for retailers and companies very dependent on the consumer, the bottom line is stock pickers can go to work, investment stock pickers. And the market also took a look at the comments from Brian Moynihan of Bank of America and JP Morgan's CEO, Jamie Dimon, and none of them were screaming 3-alarm fires or 10-alarm fires, whatever you call it. They were saying, mild recession, definitely, all the things are there on the horizon for them to say there might be a slowdown. I do think we're really at the point, especially when we get through 2-3 more weeks of earnings, that we're stock pickers have an edge, and I'm really looking forward to it. Now, bank earnings came out, JP Morgan, Bank of America, Wells Fargo, et cetera, et cetera. I was concerned about Bank of America, one of our 4 positions that we trade every week or every 2 weeks for cash. And you can see the banks had run. This is the 30-day chart. And starting in the beginning of the year, I think investors were calming down about overall concerns about the market. They're going, hey, higher interest rates are pretty good for banks, at least banks with significant exposure to retail lending and retail customers. And the stock responded quite well to that sentiment. So the actual numbers were pretty good. It's the forecast I said that is going to drive things, but it was up 11% revenue year over year. That's a big deal. And net income was up a little bit less. Higher costs, as you might guess, in an inflationary environment. EPS was a clean beat by 10%, 85 cents, 8 cents above 77. I have a forward PE estimate of 10 to 11. That's about a one-third discount um, to the current um, PE for the S&P 500. It should be for the banking sector and for Bank of America. It should be higher with rising interest rates. It's the mitigation of enthusiasm because of higher revenues and higher profits from higher interest rates is the concern that business will slow down because of a recession. Now, Moynihan confirmed, Brian Moynihan of Bank of America confirmed, good quarter, higher interest rates, bigger credit spreads. We did good. Investment banking was trashed. It's an oversimplification on my part, but everybody knew that. The IPO market is dead. Mergers and acquisitions are dead, and not dead, very calm. And one of the reasons is quantifying the impact of borrowed money to do M&A work is very hard in an uncertain interest rate environment. And they all said the economy is weakening, and he didn't say this, but he was also curious what all the other banks were saying. And his comments, sentence for sentence, echoed Jamie Dimon. Normally, I would wait a day, but what the heck? The muted initial reaction of the market and then the solidity of trading coming into Bank of America was a sure sign this was a good time to make a trade. So we sold the January week forward, 2 weeks out, 33.50 put. We picked up about 34 cents. We have an ongoing net debit. This is a core stock. And for those of you who are new to the trade, you could have done it, might still want to do it. It's a potential 1% return on capital if the options expire worthless in 15 days. Now, 1% return on capital in 15 days is about a 23% annualized return. Our target is 25. That's close enough to make this a really nice trade, a really good entry point into the Bank of America position. And I do expect to roll the position ongoing as a cash generator. Now, trading this week, as I said, I'm doing some research in Europe. And I'm doing some pasta too, but let's get real. I mean, while I'm here. But the European economy, we never have traded European stocks listed only there. We will look at multinational corporations or companies expanding their brand franchise in Europe. I'm particularly interested in American soft goods, Nike, Crocs, shoes, Under Armour, things like that, and see how they're doing here. Europe was concerned about a giant recession because of energy costs. They're one of the mildest winters on record. I've been to Rome. This is my 8th trip, and I've been there so far, total maybe 50 days, all in January. Well, last year was in March, but usually late January, February. I've had 2 days of rain in those 50 days, and it's anticipated I'm going to have thunderstorms for the next 4 or 5 days because of climate change. But it's been a very, very mild, warm winter, and that is really helping the European economy, both on the surface with tourism, but more importantly, it's limiting the need for natural gas and to a lesser extent burning fossil fuels, other fossil fuels. One of the things that will come out of this is some new names or sort of a reinvention of my thinking about existing names to see if they have a significant exposure to Europe, whether that's a good thing or a bad thing or a neutral thing, and so forth and so on. So the bottom line is we're going to trade live tomorrow, but look for trade alerts increasingly to come out via email, as we did last week, and of course closing via email, and to take advantage what I think is a return to stock picking. This is Michael Schulman. Thanks for listening.